What's up, everybody? It is Greg. So today I'm going to change my format a little bit, and I'm going to do the very first episode of a thing that I'd like to call 5-Minute Finance. So essentially I'm going to take a personal finance topic, break it down in 5 minutes, save you time. So let's jump right in. Today we are going to talk about HELOCs. In other words, a home equity line of credit. So, as in stated in what it is, a HELOC or home equity line of credit is a line of credit, meaning that you can draw money from it and you do not have to pay your own cash out of pocket. Obviously, then you incur a debt. It is very similar to a credit card. The home equity side is you are using the equity that you have in your home as collateral on the debt that you incur. Most people who give a home equity line of credit like to see a loan to equity value of around 80%. So they'll say they will give you 80% of the equity in your house available for the line of credit. Real quick for easy math, if you have a $200,000 house and say you've paid off $100,000 of it, so you have $100,000 in equity, meaning that is the amount that you have that is not subject to any debt, then the bank would give you a home equity line of credit for 80 grand. From what I have seen, normally a HELOC or home equity line of credit gives an interest rate that is floating. What I mean by floating is it can change from day to day. So it'll usually be LIBOR plus 2% or something similar to that. The cool thing is in 2020, interest rates are extremely low. So right now, it is low. You can get a home equity line of credit for extremely low interest rates. Now, the term or the maturity date on a home equity line of credit, that can change from bank to bank. So I have seen where they will give you a home equity line of credit and they may say, hey, after 10 years, everything is due. So if I drew that 80 grand out and I never paid it back, after 10 years, that entire 80 grand is due. And if I don't pay it, then the bank will convert it to a 20-year traditional mortgage where I will have regular payments and it'll be due every single month. And at least for the home equity line of credit that I have, it turns into a fixed rate mortgage, so then the interest rate won't float anymore. So you may be wondering, if you have a home equity line of credit and it has a floating rate, there is some risk in it. Obviously, if interest rates go up, so if LIBOR goes up, then my interest rate is going to go up. So why not get a fixed rate mortgage and have a much lower interest rate? And I actually agree with that in a lot of ways. I like to have a fixed rate mortgage, something that I know is consistent, especially with interest rates being low right now. You can lock in at a really low rate. So I would agree with that strategy almost entirely. But I do have one home equity line of credit. So let's talk about why you may end up wanting to get a HELOC. There may be a way that you can actually reduce the amount of interest that you pay by having a home equity line of credit. So for example, if I get a home equity line of credit and I take all of my available cash and I put it on that line of credit, meaning I pay it down, then I can have a lower principal balance than I would on a fixed rate mortgage, because I wouldn't want to put all of my money into a fixed rate mortgage because when I need it, I can't pull it back out. But with a home equity line of credit, if I put all of my money onto that debt and I do have an emergency or I do want to pull from it, I actually can. So I would have a lower principal balance being charged interest. So even if my interest rate was a little bit higher, because I have a lower principal, I may end up paying less in interest than I would on a fixed rate mortgage. Now, to be able to determine this, you're going to have to do a little bit of math. Another reason you may want a home equity line of credit is to refinance other debt with higher interest. So for example, credit card debt. If you find yourself in an instance where you have a lot of credit card debt, you may be able to get a home equity line of credit if you have any equity in your home and pay off that higher interest credit card debt and then have a lower interest loan on that money, which can save you a ton of money. Just as a plug, I do not condone in any way running a balance on your credit card. That is a no-go. So try your best to never have credit card debt. If you do have credit cards, which I do, pay them off every single month and never run a balance. Now, one of the biggest reasons that I got a home equity line of credit, because I didn't use it to refinance credit card debt because I've never had it. I have it because it is a readily available financing option at the tip of my fingers, which I really like. So I pay down my home equity line of credit as quickly as possible. But then if I ever see a rental opportunity, if there's a house that I'd like to buy, or if I am getting a new car because we just bought a van because our family is growing and we need to get a van, then I already have a financing mechanism readily available, and I can just draw from that line of credit without having to go and open a new loan every time I find an opportunity or I have to buy a car. With all credit options, you need to be smart. Do not over leverage yourself. Do not take out excessive debt. This is just a quick breakdown of a HELOC, what it is, how you can use it, and why you may be able to look into it and save yourself some money.